A company's balance sheet shows its financial situation at any given point in time. It is quite simply a formal presentation of the accounting equation. As you expect, the three sections of a balance sheet are assets, liability, and owner's equity. Have a look at the example of a balance sheet right now, and let's go over what each of the account referred to. So first, assets, cash and cash equivalents. It's a balance in checking and saving account, as well as any investment that will mature within 3 months or less. Inventory, good keep in stocks available for sale. Account receivable, it's amount due from customer for goods or service that have already been delivered. Property, plant, and equipment, assets that cannot readily be converted into cash, things like computer, manufacturing equipment, vehicle, furniture, etc. Liabilities, account payable, amount due to suppliers for good or service that have already been received. Note payable, contractable obligation due to lenders such as bank loan. Now, here's the owner equity part. Common stock refers to the amount invested by the owner of the company, and return earning is the sum of all net income over the time of the business that has not been distributed to its owner in form of a dividend. If this is confusing at the moment, don't worry, it will be explained more detail later on, which discusses the statement of retained earning. Current versus long term. Often the asset and liability on balance sheet will be broken down into current asset or liability and long-term asset or liability. Current assets are those that are expected to be converted into cash within 12 months or less. Typical current assets include account receivable, cash, and inventory. Everything that isn't a current asset is by default a long-term asset, aka a non-current asset. For example, property, plant, and equipment is a long-term asset account. Current liability are those that will need to be paid off within 12 months or less. The most common example of current liability is account payable. Note payable that are paid off over a period of time are split up on the balance sheet so that the next 12 months payment are shown as a current liability, while the remainder of the note is shown as a long-term liability. Multiple period balance sheet. What you often see when look at a published financial statement is a balance sheet, such as the one you see right now. You have two columns. One column shows a balance as of the end of the most recent accounting period, and the adjoining column shows the balance at the end of the prior period. This is done so that a reader can see how the financial position of the company has changed over time. For example, looking at the balance sheet on the following page, we can learn a few things about the health of the company. Overall, it appears that things are going well. The company's assets are increasing while its debt is being paid down. The only thing that might of concern is an increase in account receivable. An increase in account receivable could be indicative of trouble with getting client to pay on time. On the other hand, it's also quite possible that it's simply the result of an increase in sale, and there's nothing to worry about. So, quick summary: a company's balance sheet shows its financial position at any given point in time. Balance sheet are formatted in accordance with the accounting equation. Current assets are those that are expected to be converted into cash within 12 months or less. Any asset that is not a current asset is a non-current, aka long-term asset by default. Current liability are those that will need to be paid off within the next 12 months. By default, any liability that is not a current liability, it's a long-term liability.